Good afternoon. Welcome to United Church Fund's third quarter presentation on performance. Thank you for taking the time today to receive an update on our investment performance and to review a couple of upcoming changes. We're also glad to give you an economic outlook. Thank you to Michael de Guzman, a portfolio manager on behalf of UCF, who will guide most of our presentation today. But first, I just wanted to give a quick update to say that UCF's mission is to support the mission of our clients to generate outstanding returns and values-aligned investment performance. In pursuit of this mission, we are always conscious of optimizing our policies and practices. My job today, and I'm Katie McCloskey, the Director of Social Responsibility for United Church Funds, is to focus on upcoming changes to our interpretation of how to be values aligned. We consider it core to our identity to use the tools of socially responsible investing on behalf of our clients. Our socially responsible investing program primarily consists of responsible shareholder strategies like proxy voting and shareholder resolutions, investment in environmentally or socially forward structures like green bonds or community-related investing vehicles, and avoidance of certain industries or practices which are known as exclusionary screens. Our exclusionary screening policy was set in 2001 and followed the long tradition of temperance-based teachings on Protestant ideals. As time progressed, we responded to the United Church of Christ's evolving views on investment in fossil fuels and occupied territories by modifying our screens, but it's been a long time since we've really examined what were the deeply held values of the church and how best to express those values in our investment process. So we gathered a group of leaders to help us take a holistic view of SRI with a specific eye to updating our screens. We used both lay leaders, investment professionals, and clergy people in the United Church of Christ to help us guide. And we created this framework. It's a tiered framework that organizes our ongoing actions to advance a just and sustainable world. Tier 1 is identifying those industries or practices that are just invariably detrimental to the ideal of a just world. Tier 2 is to remove those companies that are worst performing, no matter their industry, in fostering human rights or environmental activity. Tier 3 will take an active stance on those companies that can be persuaded to improve by using shareholder engagement techniques. Tier 4 examines ways we can invest intentionally for a given outcome by furthering our green bond portfolio, for example. The task force recognized that key to this framework is the understanding that we need to monitor the investment performance of our funds and to periodically check in that long-term investment is not negatively impacted. So you'll here see an excerpt of our investment policy statement. Our screens reflect the United Church of Christ's still speaking faith and have been updated. Of note is the screening of private prison operators, as well as removing the gambling and alcohol screens. Our human rights and environmental screens will be the new additions to the Tier 2 framework. These screens will be operational at the beginning of the first quarter of 2018. We'll provide opportunities between now and then to ask questions about these new screens in as yet unscheduled conference calls. Watch out for these opportunities. So now we will turn it to Michael for his review and outlook.
Thanks, Katie. Thank you for giving us that comprehensive look at the screening review. As Katie mentioned, all of our investments are done with an eye towards investing with the UCC's values and with the values of all of our clients. With that being said, this is also an investment review, and here is a slide we've been showing you recently, the past few webinars, a nice summary of global markets. And on the top, you can see equity markets, on the bottom, fixed income markets. And the most important thing to note is all of those bars are to the right, are positive. And pretty largely positive for equities up at the top there. The past year has seen gains of 20% in EFI. That's EFI is international developed, so it's US, Europe, Japan. ACWI IMI is our overall benchmark. That's all country world index. That's the whole globe. Also up healthy double digits there, 17% over the past year to date, 18% over the past year. But most particularly interesting, about one up from the bottom of equities is emerging market equities. Emerging market equities have lagged the past few years, but you can see right there, up almost 30%, up 27.8% for year to date, and up 22% for the 1 year period, and really on a tremendous tear. A lot of that is related to currency, which we'll get to in a few slides. But down at the bottom, in fixed income, you can see more positives. And again, emerging markets debt, the second one there, up over 14% for the year to date. Leverage loans have done well, as has high yield. And even the Barclays Capital Government Index has done reasonably well with small positive gains, 3.5% over the year to date period. So all in all, basically all of the core asset classes, so some really positive results over the year-to-date 1 year periods, and emerging markets leading the way in the third quarter, up almost 8% alone. This slide is really better seen on our website. It's a very busy slide. It has all of our managed funds and funds of funds options. And you can go through and see, and these are, I will remind you, net of all fees. So you can take a look at the quarter to date, the year, 1, 3, 5, 10-year results there, but a little too small font for me on this slide, so easier to view on our website. So here's a high-level performance summary, and I hope I'm not rushing, but we had a lot to go over with our social responsible changes, and I want to just highlight a couple of things here. Total Equity Fund has really provided strong gains throughout 2017 and in the third quarter of 2017. As we just talked about, equities are up across all regions. An overweight to emerging markets, that means that the staff here is determined to weight more money than the benchmark to emerging markets, has been quite additive, as has manager performance. Summary, third quarter in 2017, well ahead of benchmark, net of all fees, net of UCF and manager fees. Beyond Fossil Fuels Equity Fund also has had a very strong 2017 and third quarter. It is well ahead of all fees, well ahead of benchmark, net of all fees as well. And something to look for, end of November was the BFF's 3-year anniversary, which means we now have 3-year numbers, and I really encourage you to take a look at those. Hopefully we are not tempting the fate of the investment, karma, but strong performance there. Fixed income fund, again, positive for the first 3 quarters of 2017. Not something you'd always expect to see with such strong equity returns. Emerging market debt strategies have done well. Again, that's a lot related to currency, which we'll get to later in a few slides. By currency, I mean the US dollar and how it has performed against other countries' currencies. Bank loans, will remind you, those are floating rate. That means they adjust, right? Kind of like an adjustable mortgage. And so bank loans are favored in a rising rate environment, which many think will be coming soon. Managers across the board trailed slightly, trailed their benchmarks a little bit, and as a result, for the third quarter and for 2017, slightly behind benchmark net of all fees. The balanced funds in general have been helped by an overweight to equities. Investment staff has overweighted equities, which, as you saw, really helped with the strong performance. And the outperformance of the total equity fund component as well has helped. Held back a little bit by the aforementioned underperformance of the fixed income fund, but generally doing well. For third quarter in 2017, ahead of or even with benchmark net of all fees. Finally, the alternative balance fund has had a strong 2017 absolute performance, but just a little bit behind its benchmark. The fixed income fund and a couple of the alternatives fund detracted, while the overweight to equities again was beneficial. So ahead of benchmarks for 3Q17, but slightly behind for the year-to-date period net of all fees. Total equity fund, a little more detail, generated really good third quarter performance, 5.39%. As global equity markets, as we mentioned, really strong across all regions in the third quarter. Emerging markets, again, led up almost 8%. The U.S. large cap up about 4.5%. Developed international equities, so think Europe, think the UK, think Japan, About international equities were ahead of the S&P 500, returning over 6%. And small cap had a nice quarter as well, returning about 5.7%. So really a remarkable quarter when U.S. large cap, so the biggest U.S. companies are quote unquote the laggard, but still up 4.5% for the quarter. Really strong equity returns. Asset allocation was beneficial, as I mentioned. Overweight to emerging markets really helped. We can talk about that more in a couple of slides. And then some managers really contributed well in the third quarter. In addition, QMA and LSV, some quantitative managers, are the largest outperformers, while Westfield, a small cap performer, and Bailey Gifford, an international performer, were the laggards. Although we should mention Bailey Gifford has had a very strong year to date, so really not worried about them at all right now. Fixed income fund, we mentioned high level positive returns for the third quarter. What happened was rates fell early, and if you remember, when interest rates fall, bond prices rise. So rates fell early in the third quarter, continuing the trend from the second quarter, but rose towards the end of the third quarter as people got optimistic about a potential tax reform, if you will. Emerging markets followed a strong first half with a good third quarter. Local currency index finished the quarter up over 3%, very strong. Local currency particularly benefits from that foreign exchange, that currency effect. Similar to the second quarter, Manager Alpha, again, managers underperformed a little bit. Lazard Emerging Markets Debt lagged its benchmark by a touch. A couple of the other managers also did. One thing to note, we made a manager change for bank loans, shifting to Voya. And we also are changing the benchmark for emerging markets debt to a blended benchmark, which is more accurately reflects how our manager invests for both dollar-based and local-based currency. We're going to wait to make that change in the benchmark as of year end. Beyond Fossil Fuels Fund, again, please feel free to check out the website for this one. But you can see there, third quarter, above benchmark net of all fees. Year to date, 1 year, very comfortably ahead of benchmark net of all fees. You do some quick math, and over on the right, that's about 2.5% above benchmark net of all fees. Really strong performance by our manager, QMA. Again, knock on wood that we're not jinxing them. The fund benefited from its overweights and exposure to emerging markets. Those countries such as Brazil, China, India have done very well, as I've mentioned. So finally, with our last specific fund discussion, the Moderate Balance Fund. We use this as a proxy for the balance funds in general. And for the first three quarters, performance was positive across all global regions. Equity markets ignoring the short-term politics, focusing on the improving economic results. Expectations for gradual interest rates in the U.S., starting to see that. The Fed making some rate hikes, guiding towards more rate hikes. However, the optimism for growth has been very helpful for equities and for, quote, risk product in fixed income. So core fix had positive performance, as we talked about, most of the gains being in the first half of the year. Bank loans trailing slightly, but like those for rising rate environments, which might soon appear. And again, not to sound like a broken record, emerging markets done quite well. So you can see there just a touch behind, really about even with benchmark net of all fees for the third quarter, but comfortably ahead for the year-to-date and 1 year period. So that was a fast, hopefully not too fast, review of some of the investment performance. That's nice, but we don't want to drive by looking in our rearview mirror. So how are we positioning now? So here are 5 bullet points about things we think about daily, weekly, things we read about, argue about, debate. What's going on with the global economy? The global economy is showing signs of strength. Global central banks are supportive. Yes, the U.S. Federal Reserve is more cautious, but other central banks are more supportive. U.S. equities are getting extended. Emerging markets have performed very well this year and still offer value compared to historical averages of each individual market. We'll touch on that in a couple of slides. The strengthening dollar strengthened, late 2014 all throughout 2015 and in 2016, has reversed now. It has fallen throughout the year, throughout 2017, and has provided a real extra boost to U.S.-based investors, whereas before, previous years, recently, it's been a headwind for U.S. investors with international exposure, like the UCF. Low interest rates. Low interest rates are tricky. They are a hindrance to returns, potentially, and they might pose risks. We'll talk about why in a minute, but basically, when interest rates fall, bond prices rise, and the inverse is true. When interest rates rise, bond prices fall, and when they're low like this, you kind of get asymmetric potential returns. Finally, we do favor diversification. U.S.-only approach to stocks and bonds has not generated as good returns. We'll show that in a slide, and most likely will not generate the necessary returns going forward over the long term. So that was some foreshadowing on our last bullet there. And we'll take a look at these two slides. Let's start with the bar chart. This shows the performance of the U.S., that's dark, developed international, right, Japan, UK, Europe, in the blue, and then emerging markets in the green. And you can see from 95 to 2001, the U.S. clearly led the way there with that dark bar. Then the middle set of bars from 2002 to 2007, emerging markets led the way, up 25% year over year, annualized, really tremendous. And then finally on the far right, U.S. again, from 2008 to 2016, led the way. So what does that tell us? Well, if you think about it, it means that the markets move in almost like regimes. And it's very, very difficult to predict when those regimes will shift or when they'll change. We've written about that this year. So why don't you try to switch? Why don't you try to pivot? Well, it's impossible, so maybe you should stick with just the U.S. Well, the line chart on the right shows the global, that is the whole world stock performance versus just the U.S. stock performance. The whole world in the light blue, just the U.S. in the dark blue. And you can see the global stock performance has significantly outperformed the U.S. alone. And that's through the end of last year. So be even more extended if we'd included this year when international emerging markets have outperformed U.S. in 2017. So that really is why we believe in global diversification, because you can't pick when to pivot between and among them, but a globally diversified portfolio has outperformed historically. So how are we positioned now? So these two charts could be a little confusing, so let's break them down because they're not. The line chart shows earnings, global earnings, EPS, earnings per share, for the U.S., Japan, emerging markets, and Europe. And you can see the U.S. since 2009 has really led. Got out of the gates a little faster, although EM popped up a bit. But then since then, U.S. has really just slow and steadily been the outperformer, which implies, historically, you would say, okay, that means that emerging markets and Europe have room to catch up. Not as much recovery has happened in those countries post the great financial crisis as has in the U.S. So that's one side of stock returns. The other side is valuations. So what multiple? How much are people paying for earnings and for potential future earnings? And the histogram shows how current valuations compare to historical valuations. You can see that the U.S. at 17, almost 18 times earnings is above its 25-year average. The developed markets, that is all internationally developed markets, Europe, U.S., Japan, is right in line, touch above its historical 25-year average. Europe as well, right in line. And then we go over, and Japan and emerging markets are actually below their historical valuation. So what does that tell us? Well, we think, a lot of people think there's more earnings growth to come in these international markets with historically slightly better valuations. And we do believe that valuations eventually matter. These pie charts are just to assuage any concerns that we are crazy overweighting emerging markets, that we're taking untoward bets. You can see that the all-country world index, that is the market cap, so the equity value of all the world as a percentage, is about 11.5% in emerging markets, about almost 37% in developed international markets, and about 52%, 51.5% in the U.S. So then you look at the other other pie chart, and where are we? Well, you can see we're right in line with developed, 36.9 versus 36.8, but we're about 4% overweight to emerging markets. And that has been, as we've discussed today, quite beneficial for 2017. This slide is what I was talking about with low interest rates. You can see in 1981, a fantastic year, a year of great vintages, a year when yours truly was born, was the all-time high in Treasury interest rates. And as we've discussed, as interest rates fall, bond prices rise. So where are we now? Well, we're way down low at the far end of that chart there at about 2 and change %. What does that mean? That means that it's going to be tough for treasuries to go much lower, and that the path of, if you will, least resistance, a lot of people think is higher. So what does that mean? Well, it's tough for balanced portfolios like the Moderate Balance Fund. You have to navigate a tricky environment when you've had this nice tailwind with bonds returning healthy. Now, healthy returns from bonds, now you start to worry, can they generate the income and the base returns you need? And can they be the diversifier they've been for these past 30 plus years? It's a very interesting time to be investing, and a little bit of a risk and potential headwind shifting from being a tailwind for a number of years. Finally, I love this chart because if you look at it far away, it's incredibly complicated and kind of daunting, and we call it the quilt chart. What this shows is every color is a different asset class, and if you look closely, you can see the returns of each asset class in every year. But it's almost better to take a step back and just look at how the colors shift. Take the purple, that's emerging market equities. As we mentioned, from 02 to 08, they did very well. And then, whoomp, look at the bottom. Look at how they dropped in 08 and 2011. They were some of the worst performers. And then again, pop right back up at the top. Year to date, 2017, the best. That's what we were talking about. Very difficult to kind of pivot back and forth. Similarly, U.S. small cap moves all around in here. Real estate, represented by REITs, moving all around in here. The line, those dots connected by the line, are asset allocation. So those are a blend of all of these other strategies. And what you see is asset allocation is guaranteed never to be the best performer because you're going to be invested in some things that don't do as well. But what you're hoping for, and what has been the case historically, is that asset allocation will generate healthy returns without the volatility. It won't have the big, huge swings like emerging markets do. And you can see over there on the right, the annualized asset allocation is right there in the middle with nice, healthy returns. This slide is the bond pool characteristics. It is a slide that we have shown for the past few years, and that we're just like to include to assuage some concerns about the risk we might be taking in the fixed income portfolio. So while we are incorporating emerging markets debt, while we're incorporating bank loans, we aren't taking inappropriate risk with this core kind of base foundation of our portfolios and of your portfolios. So you can see that how the fixed income fund compares to the core fixed fund, the impact manager, emerging markets debt, bank loans, and then the benchmark of the Barclays Government Credit Index. And you can see that our ratings are right in line, our maturity is in line, and the duration as well. And so it's really, we're taking an appropriate amount of risk to try and diversify this portfolio to mitigate against those potential headwinds that we discussed from potentially rising rates. So that was a little bit of a faster performance and investment review than maybe normal. That's because we really wanted to spend time talking about the very important work that we do on the socially responsible investing side of things. We do take our jobs very seriously and sincerely that we are supporting the UCF and UCC's missions. And that's really the bottom bullet point, but the most important part of this wrap-up is that we do try to invest along and in concert with the values of the UCF and of our clients. We take that very seriously. So with that, thank you very much for joining us, and I'll turn it back to Katie and see if there have been any questions from the web, from the interwebs.
Yeah, I have a question.
Oh.
There's been a lot of talk about the tax bill in the press and a lot of political back and forth. And just how will UCF position itself and potentially be impacted in 2018 and beyond with the tax bill?
Sure. So first, let's leave the politics aside. Let's just look at the economics and the investments. When President Trump was elected, as many of us and you will remember, there was a big run in certain parts of the U.S. based stock market. Small caps, small companies, financial companies, companies related to infrastructure and building things did tremendously well for a month. Then it looked like the current administration couldn't get anything done, and those all reversed, and they didn't do well, and they gave up basically all of their gains. And then again, with the optimism about the potential tax bill, those have been doing well again. So that kind of comes back to something that I've mentioned to you, Katie, and to Dawn on these webinars, to our clients. Markets tend to look past the political noise. They look at valuations, they look at earnings growth, they look at economic performance. The world right now, knock on wood, is showing strengthening economic improvement. Purchasing manufacturer indices that we've talked about before, those have shown signs that economies are growing still. That's a real positive. Markets like that. The tax bill could assuage one of the big concerns for 2018, and that's a potential slowdown in U.S. earnings. We did that slide with the lines, the multiple lines, and how the U.S. has done really well. People were worried that was starting to tail off. Obviously, if you're getting taxed less, you're going to have better earnings, right? So in the short term, at least, those will help, and we've seen that. The U.S. has started to do well. We'll see what happens if the final form of this, what it takes, if it gets passed. But people are anticipating that helping the U.S. But again, the valuations in emerging markets especially, they're just better compared to historical averages. So you need a lot of earnings to come through to have the valuations in the U.S. look better. Mm-hmm. And what happens is the market says, thanks, but what have you done for me lately, and what are you doing for me tomorrow? So the market starts to look for, okay, great, we're going to rally now, but once we're into 2018, once that calendar flips over, it starts to say, okay, so what's going to happen at the end of 2018? Mm-hmm. What's going to happen in 2019? And we do believe that eventually valuations do matter. So it's certainly a benefit for stock market. For the economy, I don't know. It really depends on what the final form takes. We talk to our managers all the time about how they're positioning, what the companies they're talking to are saying, how they're planning to invest or not invest or return capital. But it's certainly a good thing for risky assets in general. The other tricky thing is it will have an impact on fixed income. If there is economic growth from this, it will give more support to the U.S. Federal Reserve hiking interest rates, which is what we talked about with potentially those interest rates rising, which could be a headwind for bond investors, and which is where we would think, and theoretically, things like the floating rate loans, our bank loans and emerging markets debt could help mitigate those rising interest rates. But as you can tell, we worry about, lose sleep over all of this all the time on your behalf. And we look forward to updating you as we find out what the eventual tax bill will look like. And hopefully it will be beneficial for not just the stock market, but the U.S. economy in general.
Thank you, Michael.
Absolutely, Katie. Thank you very much.
And thank you all for joining in. And we look forward to our next fourth quarter presentation. And happy holidays to you all. Thank you very much.